My dear students, welcome back to our channel. In this video, I will be explaining the BBA 5th semester subject Financial Markets and Services as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 5 first important short question is: what is mutual fund? A mutual fund, MF, is a financial service where money from many investors is pooled together and invested in stocks, bonds, money market instruments, or other assets by professionals. In simple words, many people give money, experts invest it, everyone shares the profit or loss. Mutual funds are managed by asset management companies, AMCs. The professional fund managers decide where to invest the money based on market conditions and the fund's objective. Example: suppose 1,000 people invest 10,000 rupees each in a mutual fund. The AMC now has 1 crore rupees to invest in a mix of stocks and bonds. If the investment grows to 1.2 crore rupees, all investors share profits proportionally. If it falls to 90 lakh rupees, the loss is shared proportionally. Key features: 1. Diversification. Money is spread across many investments, less risk. 2. Professional management. Experts manage your money for better returns. 3. Liquidity. Investors can buy or sell units easily. 4. Small investment. Even small amounts, 500 rupees to 1000 rupees, can be invested. Easy way to remember: mutual fund is equal to pool money plus professional investing plus share returns. Mutual funds are popular in India because they allow small investors to participate in big investments, gain professional expertise, and grow wealth without directly buying shares or bonds. Next important short question is: 2. AMC functions. AMC functions. An asset management company, AMC, is a company that manages mutual funds and invests money collected from investors in stocks, bonds, or other financial instruments. AMCs play a key role in helping investors grow their wealth safely. Functions of AMC: 1. Fund management. AMC decides where and how to invest the pooled money according to the fund's objective. 2. Research and analysis. AMCs study the financial markets, companies, and sectors to make informed investment decisions. 3. Portfolio diversification. They invest in a mix of assets to reduce risk and increase returns. 4. Monitoring and reporting. AMC continuously tracks investments and provides regular statements to investors. 5. Investor support. AMC helps investors with buying, selling units, queries, and guidance. Example: if you invest 50,000 rupees in a mutual fund, the AMC manages this money along with others' funds. It decides which stocks or bonds to buy, monitors them, and reports your portfolio performance monthly. Easy way to remember: AMC is equal to manage funds plus research plus diversify plus monitor plus support investors. AMCs ensure that investors' money is professionally handled, risks are minimized, and returns are optimized. Next important short question is: 3. Mechanics of MF operations. Mechanics of mutual fund operations. The mechanics of a mutual fund, MF, explain how a mutual fund collects, invests, and manages money from investors. It's the step-by-step process of MF operations. Step 1. Collection of funds. Investors invest money in a mutual fund by buying units. The total money collected is called the fund corpus. Step 2. Investment of funds. The AMC invests the pooled money in stocks, bonds, government securities, or other instruments according to the fund's objective. Step 3. Unit allocation. Investors receive units proportional to their investment, representing their share in the fund. Step 4. Valuation, NAV. The value of each unit is called the net asset value, NAV, calculated daily based on the fund's total assets minus liabilities. Step 5. Redemption and returns. Investors can sell units back to the fund at the current NAV. Profits or losses are shared based on their units. Example: if you invest 20,000 rupees in a mutual fund, the AMC pools it with others' money, invests it in stocks and bonds, and allocates units worth 20,000 rupees. If the portfolio grows, your unit's NAV increases, giving you a profit when redeemed. Easy way to remember. Collect, invest, allocate units, calculate, NAV, redeem. This mechanism ensures efficient fund management, transparency, and fair returns for all investors. Next, Unit 5. Long questions. First important long question is Mutual Funds History. Mutual funds, MFs, are a type of financial service that allow many investors to pool their money together for professional investment in stocks, bonds, or other assets. The idea of mutual funds has a long history, starting in Europe in the 18th century. Early history, Europe. The first modern mutual fund was launched in the Netherlands in 1774. It allowed investors to pool money to invest in a diversified portfolio of stocks and bonds, reducing individual risk. Later, in France, 1822, and the UK, 19th century, mutual funds became popular for middle-class investors seeking safer, diversified investments. History in the United States. The first U.S. mutual fund was the Massachusetts Investors Trust, started in 1924. Mutual funds grew in popularity because they allowed small investors to access professional management and diversified portfolios. History in India. Mutual funds in India were introduced in 1963 with the establishment of the Unit Trust of India (UTI) by the Government of India and Reserve Bank of India. UTI allowed Indian investors to invest in equity, bonds, and government securities, which was not possible individually. In the 1990s, after economic liberalization, many private and foreign mutual funds entered India, increasing options for investors. Today, India has dozens of mutual fund companies, including SBI Mutual Fund, HDFC Mutual Fund, ICICI Prudential, and more. Example: if an Indian investor in 1965 wanted to invest 1,000 rupees safely in the stock market, they could invest in UTI, which pooled funds from many investors and invested professionally. Today, modern mutual funds allow systematic investments, SIPs, systematic investment plans, and multiple schemes. Easy way to remember. Europe, US, India, modern SIPs. In short, mutual funds have evolved over 250 years to help investors access professional investment, diversification, and growth opportunities. In India, they started with UTI in 1963 and now offer a wide variety of schemes for all types of investors, making investment safe, convenient, and accessible. This historical perspective shows why mutual funds are trusted and widely used in modern financial markets. Next important long question is: 2. Discuss the classification of mutual funds. Classification of mutual funds. Mutual funds, MFs, can be classified in different ways based on their investment objectives, structure, and returns. Understanding the classification helps investors choose the right fund according to their needs. 1. Based on ownership structure. 1. Open-ended funds. Investors can buy or sell units anytime at the current net asset value, NAV. Example, HDFC Equity Fund, you can invest or redeem anytime. 2. Close-ended funds. Funds have a fixed number of units and a fixed tenure. Units are traded on the stock exchange. Example, DSP BlackRock Infrastructure Fund, units listed on the NSE or BSE. 2. Based on investment objective. 1. Equity funds. Invest primarily in stocks shares for long-term growth. Example, SBI Blue Chip Fund. 2. Debt funds. Invest mainly in bonds, government securities, or fixed income instruments for stable returns. Example, ICICI Prudential Bond Fund. 3. Balanced hybrid funds. Invest in a mix of equity and debt to balance risk and return. Example, HDFC Balanced Advantage Fund. 4. Money market liquid funds. Invest in short-term instruments like treasury bills, commercial papers for high liquidity and low risk. Example, Kotak Liquid Fund. 3. Based on return type. 1. Growth funds. Focus on capital appreciation. Investors earn money when NAV increases. 2. Income dividend funds. Provide regular income through dividends. 4. Sectoral thematic funds. Invest in a specific sector or theme like technology, pharma, or infrastructure. Example, ICICI Technology Fund invests mainly in IT companies. Easy way to remember. Open-close equity debt hybrid growth income sectoral. Example to summarize. An investor has 50,000 rupees. Wants long-term growth, invests in an equity growth fund, open-ended. Wants regular income, invests in a debt dividend fund. Wants moderate risk, invests in a balanced fund. In short, mutual funds are classified by ownership, investment objective, returns, and sectors. This helps investors match their goals, risk tolerance, and investment horizon, making investment smarter and more efficient in India's financial markets. Next important long question is 3. Discuss the advantages and disadvantages of mutual funds. Advantages and disadvantages of mutual funds. Mutual funds, MFs, are very popular in India because they allow small and big investors to pool money and invest professionally. Like any investment, mutual funds have pros and cons. Advantages of mutual funds. 1. Professional management. Experts in asset management companies, AMCs, manage your money, deciding where to invest for the best returns. 2. Diversification. Mutual funds invest in many stocks, bonds, or assets, reducing the risk of losing all money in one investment. 3. Liquidity. Open-ended mutual funds allow investors to buy or sell units anytime, providing easy access to cash. 4. Small investment options. Even small amounts, like 500 rupees to 1000 rupees per month, can be invested through SIP, Systematic Investment Plan. 5. Convenience. Investors do not need to track markets or manage portfolios. The AMC handles research, buying, selling, and record keeping. 6. Transparency. Mutual funds provide regular NAV updates, performance reports, and portfolio details. 7. Tax benefits. Certain mutual funds, like ELSS, equity-linked savings schemes, offer tax savings under Section 80C. Disadvantages of mutual funds. 1. Market risk. Investments in stocks or equity-linked funds can fall in value, and investors may lose money. 2. Costs and fees. AMCs charge management fees, entry-exit loads, and other charges which can reduce returns. 3. No guaranteed returns. Unlike fixed deposits, mutual funds do not guarantee returns. 4. Over-diversification risk. Some funds invest into many assets, which may dilute potential gains. 5. Dependence on fund managers. Performance heavily depends on the skills of fund managers. Poor management can reduce profits. Example. Suppose an investor invests 50,000 rupees in an equity mutual fund. If the stock market rises, NAV increases profit for the investor. If the market falls, NAV decreases loss shared proportionally. The investor doesn't need to track each stock. The AMC manages everything. Easy way to remember. Advantages: professional plus diversified plus liquidity plus small plus convenience plus transparency plus tax, PDLSCT. Disadvantages: market risk plus fees plus no guarantee plus over-diversification plus manager dependence, MFNOM. In short, mutual funds are smart, convenient, and accessible, but investors should understand risks, costs, and choose funds carefully to match their financial goals. Next important long question is 4. Estimating the net asset value. Estimating the net asset value, NAV. Net asset value, NAV, is the per unit market value of a mutual fund. It represents the price at which investors can buy or sell fund units. NAV is calculated daily and helps investors know the value of their investment. Formula for NAV. NAV is equal to total assets of fund, liabilities, total number of units outstanding. Total assets, all investments of the mutual fund, stocks, bonds, cash, etc. at current market value. Liabilities, expenses, fees, or obligations of the fund. Units outstanding, number of units held by all investors. Example. Suppose a mutual fund has total assets is equal to 10 crore rupees. Liabilities is equal to 50 lakh rupees. Units issued is equal to 1 crore units. So, each unit of the fund is worth 9 rupees and 50 paise, and investors can buy or redeem at this price. Importance of NAV. Determines by sell price. Investors use NAV to buy new units or redeem existing units. Tracks performance. NAV shows how the value of investments grows or falls over time. Transparency. Daily NAV updates provide clear information about fund value. Key points. NAV changes daily because the market value of assets changes. For open-ended funds, NAV determines the current trading price. For close-ended funds, NAV helps in calculating market value, though units trade on the stock exchange. Easy way to remember. NAV is equal to assets, liabilities, divided by units shows per unit value of fund. In short, NAV is the heartbeat of a mutual fund, telling investors how much their units are worth. By checking NAV regularly, investors can track performance, decide when to buy or redeem, and understand the true value of their investment in mutual funds. This makes NAV simple, transparent, and essential for all mutual fund investors in India. Next important long question is 5. Evaluating mutual funds. Evaluating mutual funds helps investors choose the right fund and track its performance over time. Since mutual funds invest in stocks, bonds, and other instruments, it is important to check how well the fund is performing and whether it meets your financial goals. Key measures for evaluating mutual funds. 1. Net asset value, NAV, growth. NAV indicates the per unit value of a fund. Comparing NAV over time shows whether the fund's investments are growing. Example, if NAV increases from 10 rupee to 12 rupees in a year, the fund has grown 20%. 2. Total returns. Includes both capital gains, increase in NAV, and dividends received by investors. Example, if NAV grows 10% and dividend is 2%, total return is equal to 12%. 3. Risk-adjusted performance. Looks at returns relative to risk taken. Tools like Sharpe ratio help compare funds with different risk levels. Example, a fund giving 12% return with low risk is better than 15% return with very high risk. 4. Expense ratio. Shows cost of managing the fund, including AMC fees. Lower expense ratio means more of your money is invested for growth. 5. Consistency of performance. Check fund performance over 3, 5, or 10 years. Example, a fund consistently earning 10% annually is more reliable than one giving 20% one year and -5% the next. 6. Peer comparison. Compare funds' returns and risk with similar category funds. Helps identify top-performing funds in the same segment. Example. Suppose an investor is evaluating to equity mutual funds. Fund A, 12% average annual return, moderate risk, 1% expense ratio. Fund B, 15% average annual return, high risk, 2% expense ratio. The investor may choose Fund A for steady growth with lower risk depending on goals. Easy way to remember. NAV plus total return plus risk plus cost plus consistency plus comparison, key points for evaluating mutual funds. In short, evaluating mutual funds is essential to maximize returns, minimize risks, and achieve financial goals. By checking NAV growth, total returns, risk-adjusted performance, expenses, and consistency, investors can make informed decisions and invest smartly in India's financial markets.